Caleb, and I'm today's moderator. If you are just joining us, please go to the chat and introduce yourself with your name and the region you represent. As a reminder, this office hour session is being recorded for public records. Next slide, please. How to ask a question. All questions must be submitted in the chat. Please type your organization and question into the chat box. The team will read questions out loud at the end of the presentation and will provide answers throughout the presentation in the chat or out loud if time is permitting. As time allows, we will also unmute folks to ask questions live. Alongside our presenters, we also have several HCD staff, including ESG representatives, ESG CV grant administrators, and other consultants who can help to answer questions during the Q&A session. If we cannot answer a question, we will either get back to you or recommend that you complete a HUD AAQ. Next slide, please. Please note that both the slides and the recording will be sent to all participants within 1 week of today's session. Next slide, please. Today's agenda: ESG updates and resources, ESG CV updates, office hours updates, upcoming trainings, ESG CV Q&A, and today's spotlight session is Indirect Costs with David Munoz. Next slide, please. And ESG upcoming events. 2023 ESG Annual NOFA Application Review. The COC awards are listed on the ESG webpage, and the Balance of State Award announcements anticipated in February 2024. Next slide, please. Your ESG team representatives are on this slide. The slide deck will be emailed to you. Next slide, please. ESG CV updates, reminders for performance milestones. For additional funds, the final drawdown deadline is 3/31/2024. The final RFF deadline is 4/15/2024. And the contract agreement expiration date is 6/30/2024. Next slide, please. Upcoming office hour topics: ESG's monitoring tools on 2/28, on 3/6, client eligibility and services by ESG component, on 3/13, leveraging and braiding funds, on 3/20, documenting VAWA compliance. Next slide, please. At this time, are there any questions? Okay, there are no questions. Next slide, please. How to contact us. If you have any further questions, please contact us for annual ESG. Please reach out to your ESG representative or ESG NOFA at hcd.ca.gov. For ESG CV, please reach out to your grant administrator. Next slide. Now, let's turn our attention to today's Spotlight series, Indirect Costs, featuring David Munoz. David, take it away.
Awesome. Well, thank you, Shavana, and good morning, everybody. Welcome to today's office hours presentation on indirect costs. Next slide, please. So why are we here today? Let's face it, when we hear the term indirect costs, we sometimes feel like we're Charlie trying to decipher the mail system. And our goal today is to hopefully save our sanity and help folks navigate through the murky waters of indirect costs. So I know it's early for this type of topic, so grab a coffee, let's embark on this journey together. We have 4 main stops on our journey. First is cost principles. Second is classifying costs. Third is allocating indirect costs. And then fourth is charging for indirect costs because, hey, we're not in this for charity and folks need to get paid. Next slide, please. So to start off, we'll discuss the cost principles and why they are really the foundation for charging any cost, whether direct or indirect. to a federal grant. And this slide outlines a 3-level framework that you all should utilize when evaluating which costs may be charged to the ESG award. So starting at that highest tier, you start with the Federal Uniform Guidance, which is located at 2 CFR Part 200. The next level down is the HUD ESG program regulations, which are located at 24 CFR Part 576. And then the third is your HCD ESG standard agreement. And really the key point here is that all costs paid for with ESG grant funds must be allowable under all 3 tiers. So the uniform guidance, the ESG program regulations, and your agency standard agreement with ESG. And so we start really broad, and then we start narrowing it down as we go through each layer of that framework. Next slide, please. So starting with the broadest layer of that framework, under the uniform guidance, all costs paid for with federal funds must be necessary, reasonable, allowable, and allocable. So costs are necessary if they're absolutely required for the proper and efficient performance of the federal award. Reasonable, meaning it does not exceed what a prudent person would pay in similar circumstances. And so the timing of those costs is super important. As you all may have remembered, in 2020, when the pandemic first started, there was a lot of price gouging. And so the cost of certain cleaning materials at that time was a lot higher. And so seeing that rate or cost for those items was not unreasonable given that particular circumstance. Allowable, meaning that it conforms to any limitations or restrictions set forth in that 3-layer framework. So within the cost principles of the uniform guidance, within the ESG program regulations, and with your grant agreement with HCD. And then fourth and finally is allocable or properly assigned or tied to a federal grant award. And we'll talk a little bit more about allocation of costs as part of today's presentation. Next slide, please. So moving to the second layer of that framework, which is the ESG program regulations. All costs paid for with ESG grant funds must be included within one of the 6 eligible activity categories. They must be incurred for the benefit of an eligible ESG beneficiary. They must be adequately documented. They must be consistent with your agency's policies and procedures. And then they must be treated consistently as either direct or indirect costs. Next slide, please. And so lastly, the third and most specific level of that framework is your agency standard agreement with HCD. So all costs reimbursed with HCD ESG funds must be included within the approved activity component budget and incurred during the approved grant budget period. So agencies are, strongly recommended to review their standard agreement with HCD to determine which eligible activity components your agency was approved for and in which amounts. The specific line items in your budget will determine the types of activities and expenditures that your agency can ultimately charge to the ESG award. And on this slide, you see a screenshot of, I believe it's Exhibit E and F, which is part of your standard agreement with HCD in case you ever need to reference it. Next slide, please. So now that we have established a foundation for determining which costs can be charged to the ESG award, let's talk about how to distinguish between what is a direct cost and an indirect cost. So direct costs are costs that can be specifically assigned to a particular award or activity relatively easily and with a high degree of accuracy or certainty. This means that you could clearly tie the cost to the ESG award or to the specific ESG activity component. You should be able to go into as much detail as saying how much the expenditure was for, exactly which eligible activity component and or participant that it benefited. On the other hand, indirect costs are those that have been incurred for shared or joint objectives that cannot be readily assignable to a particular award or activity. This means that a particular expense is not as easily tied to a specific grant or activity because it benefits multiple cost objectives or multiple programs. We always get the question of, can you just tell me a more scientific approach to what is a direct versus indirect? And unfortunately, there is not really a universal rule for classifying certain costs as either direct or indirect under every single accounting system for each and every agency. A cost may be direct with respect to some specific service or function that your agency provides, whereas it could be indirect with respect to the federal award or ESG or the final cost objective. And so therefore, it is essential that each item of cost be treated consistently as either a direct cost or indirect cost, but never both. And the reason for that is you always want to avoid the potential for double charging, or what some folks call double dipping, against any federal award. And by classifying a cost as either direct or indirect, that will really govern how it gets allocated or charged to a specific grant. Next slide, please. And so this slide illustrates an example of differentiating direct costs from indirect costs. So starting from left to right, if staff member A is solely dedicated to the ESG or ESG-CV award, then 100% of their salary and fringe benefits are directly allocable to the ESG or ESG-CV award. Likewise, if staff member B in orange works on the ESG-CV program, as well as another federal grant, then that employee's costs can be split on a pro rata basis using the direct number of hours or time spent on each grant program. And that would be based on what's documented in their timesheets. And then the third example is, let's say you have a payroll or human resources department. All of the costs that are incurred by those departments are really indirect costs because they're processing payroll for your entire agency. And so they benefit more than just the ESG-CV program or another federal award. They're benefiting your agency as a whole. And so that is really where you get to distinguishing between direct and indirect costs. Next slide, please. And I know I said that there's no universal rule or no one size fits all approach to classifying costs, but we did want to provide you with a few examples of costs that are typically classified as direct costs under the ESG program. And again, we're still operating within that cost principles framework, or that 3-tier framework. So starting with uniform guidance, the ESG regulations, and your standard agreement. Some examples of direct personnel costs are any staff costs, so things like salaries, wages, benefits, that are incurred to provide necessary case management services, those are allowable direct costs. To determine the amount of staff costs that are allocable to the ESG award, you're going to have documentation of the amount of time that case manager spent, directly assisting the eligible ESG beneficiaries. And in that third column of this table, we kind of rehash the type of supporting documentation that is needed to demonstrate that it is a direct cost that is allocable to the ESG award. And I believe a few office hour sessions ago, we had a discussion on proper financial record keeping. So if you want some more details on that, I would highly recommend that you go back and reference that office hours. On to the next kind of direct personnel or direct non-personnel cost example. Let's say your agency purchased a vehicle that is being used exclusively by the street outreach team to serve and transport ESG beneficiaries. That again is an allowable direct cost. To determine the amount of that vehicle's cost that is allocable to the ESG award, you're going to need some documentation in terms of the use of that vehicle to demonstrate that if we paid 100% of that vehicle is being used exclusively for the ESG program. Or if it's only being used 50% of the time for street outreach, then only 50% of that cost is being charged to the ESG program. And then the last example that we have for you for direct costs is with respect to participant support costs. So things like rental assistance payments made on behalf of an eligible ESG beneficiary, again, definitely an allowable direct cost. You'll just need to have the appropriate documentation to kind of demonstrate that it's directly allocable to the ESG award. Next slide, please. So on the other hand, you'll see that these common examples of indirect costs are a little more difficult to tie to a particular grant or activity. So starting with examples of indirect facilities costs. If your agency purchased office equipment and supplies, so things like furniture, printers, paper, staplers, or pens, for general use at a facility that supports multiple programs, it's not super easy to say, oh, well, that particular chair or that particular stapler is for the ESG program, since it's likely to be used by staff that are supporting multiple programs, not just ESG alone. Similarly, for indirect administrative costs, some staff will perform tasks that support agency operations across the board. So your payroll division, human resources department, and those are also examples of indirect costs because it's very difficult to tie back that payroll division's time and say, oh, well, this was spent on ESG or this was spent on another program. And so one key takeaway from these examples on this slide is that all indirect costs are either facilities or administrative costs. However, not all administration or facilities costs are necessarily indirect. There may be situations in which you have certain facilities expenses or administrative expenses that you could directly tie relatively easily and with a high degree of accuracy and say, hey, this is a direct cost that can be tied to the ESG program. But that's just one thing to kind of keep in mind as we go through the rest of today's presentation. Next slide, please. So now that we've kind of gone through, the method for classifying costs as either direct or indirect and understanding that we just need to be consistent about how we're classifying costs. You probably noticed from the examples that there are many costs that cannot be easily assigned to a federal grant, which was kind of those facilities and administrative costs that we talked about in the last slide. And really the key is to understand what options you all have available for allocating these indirect costs to your federal grant. And to do so in a way that complies with the uniform guidance as well as the ESG program regulations. And generally speaking, there are three main methods for allocating indirect costs to, and we'll say ESG award for today, but really any federal grant award. So the first is the de minimis indirect cost rate. The second is the negotiated indirect cost rate. And then third is a cost allocation plan. And we'll kind of talk about what each one of these methods are, certain requirements that come along with them. And our goal is to introduce these concepts at a fairly high level, and then point you to further resources where you can get into the granular details about what you need to do to actually be able to utilize or implement these methods. So, take this with a grain of salt. We are going to be covering it at a high level, but should you have any additional questions regarding any of these items, we're here to assist you all, and we'll definitely point you to some resources that HUD has published that are actually very useful and provide some pretty informative discussions. Next slide, please. So the first method that we'll talk about is the de minimis method, and it's one of the most commonly used indirect cost methods. So agencies may elect to charge a de minimis rate of 10% of modified total direct costs, or MTDCs, which may be used indefinitely. And it used to be that if your agency had previously negotiated a rate, you would no longer be eligible for the de minimis method. A few years ago, that was actually updated. And so now the rule is, as long as you do not have a currently approved or effective negotiated rate, your agency may utilize the de minimis rate, which is 10% of modified total direct costs. Now, there are a few additional requirements that you should be mindful of if this is a method that your agency is exploring. So agencies, and this includes, grantees, subrecipients, and so forth, that receive over $35 million in direct federal funding, or if you have a current negotiated indirect cost rate, you may not utilize the 10% de minimis rate. And so if you're not sure whether your agency receives over $35 million, I would highly recommend you consult your finance department or staff. You can also look at your agency's most recent single audit. Towards the tail end of that document, there's usually a section that's titled Schedule of Expenditures of Federal Awards. And that should give you a pretty decent idea of the amount of federal funds that your agency receives or expends in a fiscal year. If you're over 35 million, right off top, this is not a method that your agency is going to be able to utilize. If you're below that amount and that you don't have a currently negotiated rate, this is definitely an option that your agency can explore. Once chosen, your agency needs to be pretty good about utilizing this method consistently across all federal awards until you choose to negotiate for an indirect cost rate. One of the benefits of the de minimis method is no additional documentation is required to justify that 10% de minimis rate. So it's not like you have to prepare additional documentation or submit it to anyone. You can just request a de minimis rate. and HCE will, incorporate that as part of your standard agreement. And at that point, you would be able to charge 10% of modified total direct costs to get reimbursed for some of those indirect costs that your agency has. Next slide, please. So the second method is a negotiated indirect cost rate, or what some folks call NICRA, because it becomes a negotiated indirect cost rate agreement. And this agreement formalizes the negotiation process and contains the established indirect cost rate, the effective period of that rate, the location to which the rate is applicable to, as well as any programs to which that rate applies. Again, we have a couple of caveats here that you all should be mindful of. So any agency that receives more than $35 million, those that are not eligible to utilize the de minimis method, must submit what's known as an indirect cost rate proposal to their cognizant federal agency. And the cognizant federal agency is going to change from agency to agency. What the cognizant agency means is typically whichever federal agency provides the largest amount of direct federal funding to your agency. Again, you could look at your single audit towards the tail end of the document. And it's usually organized by federal agency, and it'll kind of tell you the amount that your agency is receiving from each one of those federal agencies. So it could be HUD, or it could be another federal agency. If HUD, represents the largest amount of funds awarded to you by a federal agency, then your cognizant agency is technically the U.S. Department of Health and Human Services. So HUD has kind of shifted that responsibility over to DHHS. And so in those cases, you would be submitting that indirect cost rate proposal to DHHS. Now, an indirect cost rate proposal is a document that's used to kind of calculate or establish the indirect cost rate, which is expressed as a percentage that can then be applied to a specific grant or program to determine the amount that you can charge for indirect costs. It is important to note that developing this proposal is fairly complex. It's rigorous. And it's highly recommended that you all, work with a CPA to complete the document. It's not a light lift at all. And so you want to make sure that you're dotting those I's and crossing those T's. In the event that your agency does have an approved NICRA, it is time bound, so it will expire. And then you must, develop and submit an updated proposal for review and approval to continue utilizing a negotiated indirect cost rate. Next slide, please. So then the third and final method is a cost allocation plan. And a cost allocation plan is a document that identifies and explains the distribution of allowable direct and indirect costs, and it declares the allocation methods that are used for distribution. And generally, there are three acceptable sub approaches to calculate the indirect cost rate in a cost allocation plan, which are the simplified allocation method, the multiple rate allocation method, and then the direct allocation method. Any agency that's receiving $100 million or more in direct federal funding is actually required to submit a cost allocation plan to its cognizant agency for indirect costs. All of the costs and the data that are used to inform that cost allocation plan should be supported by formal accounting and other financial records. And again, this is not a document that I would recommend you go alone on. Definitely recommend that you all work with a CPA as you prepare and develop that cost allocation plan to make sure that you're meeting all of the requirements and nuances that your cognizant agency may be looking out for. Next slide, please. So now that we have a sense for the acceptable methods of allocating indirect costs, which are de minimis, negotiated indirect cost rate, or a cost allocation method, let's dive into how you actually charge for indirect costs or get reimbursed for them. I think one of the most common misconceptions with indirect costs is that the indirect cost rate or the percentage gets applied to your overall ESG award, which is actually incorrect. So the indirect cost rate is not applied to the overall ESG award. Instead, it is only applied to a predetermined set of direct costs, which is also referred to as the direct cost base. So it's that circle all the way in the left in blue. And then to calculate the amount of indirect costs that you can charge to the ESG award or any other federal award for that matter, your agency would be responsible for multiplying that allowable direct cost base by your agency's indirect cost rate. And then you'll arrive at the amount of indirect costs that you can charge to that federal award. And so this is really the formula that you would be utilizing regardless of the method chosen. And so the direct costs included in that base, as well as the percentage used, is dependent on the specific method that's utilized by your agency. So again, the formula is the same, but what goes in the direct cost base as well as the percentage may change depending on the method. Next slide, please. So if your agency is utilizing the de minimis method, then the direct cost base as well as the indirect cost rate or the percentage are predetermined for you. As I mentioned earlier, there's no additional documentation that you all need to provide for this because your agency is essentially accepting the terms of what is part of your direct cost base as well as that rate or the percentage. And so the direct cost base, when utilizing the de minimis method, is known as the modified total direct costs, or MTDCs. And MTDCs are that predetermined cost base, which is defined in the uniform guidance and illustrated on this slide here. So certain direct costs that are considered MTDCs or modified total direct costs are things like direct salaries, wages, and fringe benefits, supplies and materials, services, travel, and up to the first $25,000 of each subaward. Certain direct costs that are not included in that base is not to say that they're not allowable direct costs. So remember when we talked about the vehicle purchase for the street outreach program, that is an allowable and allocable direct cost. The only difference is you wouldn't add the cost of that vehicle into your cost base that gets multiplied by 10% to arrive at the amount of indirect costs that you can charge to the program. So things that are not included in the modified total direct costs or MTDCs base are things like equipment, things like capital expenditures, participant support costs. So any rental assistance that's provided on behalf of a beneficiary, that is not included in the MTDCs. Any grantee rental costs, as well as the portion of each subaward in excess of $25,000. And so this formula, at least when utilizing the de minimis, is pretty set in stone. You just need to figure out what is my MTDC amount, multiply that by 10%, and then you'll be able to arrive at the amount of indirect costs that you can get reimbursed for. And so in the next few slides, we'll kind of go through an exercise of what this looks like in the budgeting process, as well as when you're trying to submit an RFF. So in this slide, we have an example of an agency that, this is just for an example, this isn't a real budget for anybody. It's an example of an agency that received $1 million ESG award from HCD to implement an emergency. And we're also assuming that this agency is utilizing the de minimis method to budget allocate their indirect. We split them up into the phases that you may go through as you are developing or preparing your budget for this particular program or activity. So in the first phase, you kind of outline what your initial budget is. To add each one of those line items. Am I back? No? All right. So we were talking about the budget. So in the first phase, you're kind of figuring out, just start with what your actual direct costs will be, whether that's personnel, non-personnel, or participant support costs. In this specific example, your agency determined that the total amount of direct costs is $933,000. And as part of this phase, it's usually helpful to figure out what is and is not included from your direct cost base. And as we explained in the previous slide, when utilizing the de minimis method, that direct cost base, or your MTDC, modified total direct cost base, is predetermined for you. So you really just need to go through each one of those line items, cross-reference it with the chart that we had in terms of what is and is not an MTDC. And then you can kind of fill out the third and fourth columns here. So case manager salaries, that is absolutely included in the MTDC. So we'll put that in that column. The case manager benefits, also included in the MTDC. So we put the entire direct cost amount in that column. Food is a supplier material. So again, that goes into your MTDC column. And then we reach the subawards. So we put two examples of subawards. If you recall, in that definition of what's included and excluded, it says up to the first $25,000 of each subaward is included in the MTDC. So anything in excess of that is excluded. And so you'll notice for subaward, for subrecipient number 1, we included the first $25,000 of their $85,000 contract, and then excluded the balance of that, or the $60,000. And so that's why it ended up in the excluded from MTDC column. For subaward, subrecipient number 2, their contract amount is for a total of $20,000. And so 100% of their contract gets included in the MTDC amount. Then when you move on to furniture and hotel motel vouchers, the furniture is treated as equipment. So 100% of that cost is excluded from your modified total direct cost base. Likewise, the hotel motel vouchers, those are considered participant support costs. And so 100% of that amount also is excluded from the MTDC. And when you sum up those columns, you'll notice that of the $933,000 that you have in total direct costs, only $670,000 of those actually gets included in your MTDC base. And so this gets back to that opening statement that I made where you're not applying the indirect cost rate or that 10% if you're utilizing the de minimis to your entire grant award amount. So it's not $933,000 times 10%. In this particular case, it is $670,000 times 10%. And that's really what we're getting at in phase 2, or the second piece of that table, which is you want to take what your MTDC base amount is, or the 670,000, multiply it by your indirect cost rate, which when you're utilizing the de minimis, again, it's a flat 10%. There is no wiggle room with that. And then that's how you would arrive at the total indirect cost amount that you're looking to allocate and charge to the ESG program. And then the third phase is kind of ironing out and finalizing your budget, which is to say, okay, 933,000 is going to go towards total direct costs. 67,000 is going to go to total indirect costs. And then your overall grant amount is for $1 million. And that's really the math that you would go through as you're preparing your budgets as part of your application or proposal in response to the NOFA, and kind of finalizing that as you get into the contracting stage. Next slide, please. So in this one, we are still sticking with the de minimis method. But what we wanted to highlight or illustrate here is what does it look like in practice when you're submitting your RFF. So if you recall from the last slide, technically your agency has a total of $67,000 budgeted for indirect costs. However, that does not mean that as part of your first RFF, you can just charge $67,000 in indirect costs and call it a day. You really want to go through that formula of your direct cost base multiplied by your indirect cost rate to arrive at the amount of indirect costs that you can charge to the program. And the reason you want to go and follow that formula through each RFF is, let's say 6 months from now, your original budget changes. Let's say you shift some funds from your case manager salaries over to hotel motel vouchers. Well, guess what? The moment you did that, the amount that's included in your MTDC changes, which means that the total indirect cost amount changes. And so to make sure that you are only charging the amount of indirect costs that's commensurate with what is actually included in your modified total direct costs, you just want to make sure to go through that exercise as part of each RFF. So in the first table, we provided a sample of, let's say the first RFF for that emergency shelter activity was for a total of $233,250. And that's comprised of $125,000 in your case manager salaries, $18,750 in benefits, $12,500 for food, $21,250 for the subaward subrecipient number 1, 5,000 for subaward subrecipient number 2, 12,000 for furniture, and then 38,750 for hotel motel vouchers. So again, same exact exercise. We know that salaries and benefits are included in the MTDC. So 100% of that goes into our MTDC bucket. Food, again, it's a supply, so that would also get included in the MTDC bucket. Since subrecipient number 1, we know that their contract is for 80,000, but they've only charged less than the first 25,000. So 100% of that as part of this first RFF gets included in the MTDC. And then, subaward subrecipient number 2, we know that they don't even exceed 25, so 100% goes into the MTDC. The only 2 line items that would be excluded from the MTDC are your furniture and hotel motel voucher costs. So at the end of that exercise, you kind of realize, okay, of the $233,250 that I'm directly charging to the ESG award, only $182,500 of that actually gets included in that direct cost base, or the MTDC base amount. You then take that $182,500, you multiply it by 10%, and then that will give you the total amount of indirect costs that you can charge as part of this specific RFF, which is $18,250. So then the final stage is kind of finalizing that RFF, which is $233,250 of total direct costs, plus the total indirect cost amount of $18,250. And then you'll arrive at that overall amount that you'll include as part of your request in RFF number 1, which is $251,500. And I know we could, I guess, take this example even further and add RFF number 2. The only thing I would be mindful of in RFF number 2 is, that you've already billed $21,250 for subaward subrecipient number 1. And so that the maximum amount in the next RFF that could get included into the MTDC is $3,750 because it's up to $25,000 of each subaward. Anything in excess of that would just get excluded from the MTDC, and you'd go through that same exercise and go through the math once more. But that, in a nutshell, is kind of the approach when you're budgeting, as well as when you're preparing the RFFs. The formula stays the same. You just need to be cognizant of what goes in your direct cost base, what your rate is, and when it's de minimis, it's always 10%. And then you just add what your total direct costs are with your total indirect costs, and then that's what you end up charging as part of each RFF. Next slide, please. So although the definition of MTDCs, or modified total direct costs, must be utilized for agencies that decide to employ the de minimis method, agencies that are utilizing a NICRA or a cost allocation plan may have a different cost base to determine what their indirect cost rate is. Therefore, they may have a different set of predetermined direct costs that are included, in that direct cost base. And so for that reason, it's super important to analyze, the indirect cost rates and then the direct cost basis on a case-by-case basis. And so we provided an example of a NICRA on this slide, and you'll notice that it provides the period in which this rate is effective. And I know this is a little bit outdated, but let's just pretend we are, in February of 2023, in which case we would know that the effective rate during this current period is 17.5%. that applies to location number one, and it applies to all programs based on what this specific negotiated indirect cost rate agreement states. But I do want to draw attention to right under C special remarks, it has base listed. And in this specific example, it says that their base is only direct salaries and wages, including benefits, so vacation, holiday, sick pay, other paid absences. So things like supplies, things like travel, things like subawards are not included for this specific agency's direct cost base. And then the second half of this slide, or the image on the right, is what you would see on the last page of a NICRA. You'll notice that it's executed by their cognizant agency, which in this case is actually not HUD or the Department of Health and Human Services. It's actually the U.S. Department of Labor. That only indicates that their largest funding source is the U.S. Department of Labor, which is precisely why they sent their proposal to the Department of Labor for their review and approval. But this document does contain a lot of really important information that you'll want to take into consideration, especially as you start going through that formula. So direct cost base multiplied by their rate equals indirect costs, right? So those three circles. When looking at this specific NICRA, okay, it's personnel salaries and benefits multiplied by 17.5% to arrive at the total indirect costs. And so we'll kind of see how that plays out in the next slide. So this is an example of an agency that received $1,033,625 to implement an emergency shelter activity, except they're utilizing a NICRA to budget and allocate their indirect costs. So we're going to assume that NICRA that you saw on the previous slide is the effective NICRA for this agency. And again, we're going to go through the same exact exercise as we prepare the budget. So this budget should look fairly familiar because it's almost copied and pasted. So the direct cost amount is still $933,000. Each one of those line items for case manager, salaries, benefits, the food, the subrecipient awards, furniture, hotel, motel vouchers is exactly the same. However, you'll notice as we get into columns 2 and 3, in terms of what gets included in the base, there is a difference. And that's mainly determined by what was stated in their NICRA. So if you recall in the NICRA, it said that the base only includes salaries and benefits, which is why in this case, under phase 1, you see that only $575,000 is included in the base. If you recall as well, the indirect cost rate instead of 10% was 17.5%. So we would take that 575,000, which is your direct cost base, multiply it by 17.5% to arrive at that total indirect cost amount, which in this case would be 100,625. Then the final, phase of this is to finalize the budget. So you have a total direct amount of 933,000. When you add your total indirect cost amount of 100,625, you arrive at your total overall grant amount, which is 1,033,625. Next slide, please. And so again, same agency, except we just wanted to kind of rehash what this would look like as part of the RFF process rather than just the budgeting process. So again, should look very similar as the first RFF from the agency that's utilizing the de minimis. The only difference is as they go through the exercise of determining what is included in their base, they're only including their case manager salaries and benefits. And so while they have $233,250 in direct costs, only $143,750 of that gets included in their base. From there, they take their direct cost base of $143,750, multiply it by their agency's indirect cost rate of 17.5%, to arrive at their total indirect cost amount that they can charge as part of this RFF, which is $25,156.25. And then the final piece is, all right, what's the total amount that we're charging HCD, which is your total direct amount, or the $233,250, plus your total indirect cost amount of $25,156.25. And then you'll make sure that the total amount that you are requesting as part of RFF number 1 is $258,406.25. And so again, the process and the approach is the same. It's just the figures that go inside your direct cost base and what that rate, or the percentages that will be utilized. But the formula stays the same regardless of the method that you utilize. It's just the details of what's inside each bucket that may change based on that method. Next slide, please. Well, we hope that today's office hours presentation didn't lead you further down the rabbit hole with Charlie, and instead left you feeling like you can deal with indirect costs as smoothly as Alan counting cards in Vegas. Effortless, precise, maybe a little bit thrilling. And if not, we're all in this together. So feel free to reach out, and we'd be happy to support in any way that we can.
Just one question, David, that came up while you were talking, and it was midway through, so this may not be as relevant as it was. Is a pass-through grant from a federal funding source, like ESG, considered direct or indirect?
Pardon, what was the beginning part of that?
Sure. Is a pass-through grant from a federal funding source, like how ESG comes through the state of California, is that considered direct or indirect?
So the grant itself isn't what is you're classifying as direct or indirect. It's your expenditures that you're classifying as direct or indirect. The grant that you receive, even if it's passed through, is generally considered revenue, not an expenditure. I'm not sure if that helps address the question.
I think it does, and that was our only question, so we can wrap up.
Thank you, David, for a very informative session on indirect costs. A survey will pop up as you exit the session. Please be sure to answer so that we'll know the types of trainings you're interested in receiving. Thank you again to all who attended, and thank you to David for presenting today. Enjoy the rest of your day.